the main markets that have spurred LNG growth over the past few years, and that some contract renegotiations are happening within the LNG world.
And I should point out that Cheniere is creating terminals to export LNG to the rest of the world. They will be the first U.S. company to be able to do that, and they should be up and running by December.
Correct. And so I think the counter thesis to that is, right now in terms of the overall amount of LNG supply coming on in the world is about 140 MTPA coming in the next few years, including Cheniere's capacity. Well, that's kind of based on demand that had grown during a period when the price had been around $11 to $12. A lot of new projects came into the marketplace, and then demand began leveling off because prices, there was no glut. There was actually a shortage because of the Fukushima incident. That created price rises up to $19 per MMBTU. So that created even more impetus to try and build more capacity. And however, at that price, demand began to level off because people shied away from that very high price. And now what's happening is the price is now, delivered price in Asia is about $8 per MMBTU per unit. So that, I think, will probably stimulate demand over the long term. And Cheniere is the first into the market, and we'll be able to take advantage of that.
But nevertheless, I mean, isn't Cheniere relatively insulated from any kind of commodity move? I mean, basically, you're an energy exporter, and you pay Cheniere for the right to use their terminal. You have to pay them whether or not you use it. So it kind of doesn't even really matter what the price is or matter what China's going to buy.
Precisely right, because what other projects elsewhere in the world, the government of Qatar, also Australian projects are offering is really, we're selling you LNG and you have to take it. You have to take on all the commodity risk with it. What Cheniere is offering is not really LNG per se. It's an option to take LNG, right? So they're selling a hedging instrument, allowing companies who are off-takers who need LNG to buy it or not, depending on the price. So that's kind of a different product, and it's an attractive product. And I think Cheniere's going to be able to get that price, that capacity fee, year in, year out for the next 20 years, regardless of where the commodity price moves in the meantime.
So Cheniere has one terminal that should be up and running in December. It also has another one that it's working on building out. How much of that total capacity is already being rented out? So that I'm basically thinking of it like a really juicy dividend.
Fair enough. So if you look at it that way, they're going to build right now. They have contracted, already financed, etc. 7 trains. They actually have part of an 8th train contracted, but they've got 7 trains right now of that capacity. That comes out to something on the order of 30 MTPA of capacity, and that the utilization on that is going to be roughly 80 to 82%, and they're going to be getting paid on a per MMBTU basis, a blended average of around $2.75. So that's going to be throwing off something on the order of, on the low side, about $1.8 billion in cash flow to the parent company.
Which literally means they don't even have to do anything. They don't have to market the LNG. They don't have to sell it. They're just getting paid for the right to somebody else to sell it.
Correct.
So why would Chanos bet against that?
I mean, I guess the view is, and I think one of the things that was brought up because there was we've seen in Australia where there's been renegotiations in price on contracts, right? Now, the contracts that Cheniere has are very different from the contracts in Australia and that the Asian off-takers have, because those contracts, like I said before, are based on having to take the gas, right? So if you're obligated to take gas and to take commodity risk, you're going to want to negotiate. That's part of it. The other part of it is a lot of the Chinese off-takers who have contracted and are now trying to renegotiate are also equity investors in the same LNG projects in Australia. So they negotiate against themselves. They're deciding whether or not they're going to contribute more money to a joint venture that they don't own all of, or get a price rebate and take more cash to their own balance sheet back home.
So totally different types of contracts. One area, though, where I can make the case that Cheniere is exposed is they have a portion of their next terminal where they're keeping it for themselves. If they want to buy natural gas and then liquefy it themselves and then export it, they are taking on that commodity risk. How much of that risk is a reality?
So they don't really have to take on the risk, because if they decide that they can't sell in the marketplace, they have a several-month kind of look forward, right, to decide whether or not they're going to want to sell it or market it in the marketplace. And if they don't, then they don't have to buy the gas, and they don't have to be long the commodity risk. So it basically means that their capacity utilization is 80, like I said, 80 to 82%. It doesn't get up to 100%, but they don't have to take risk on that gas if they don't want to. And because they're basically buying their own capacity from themselves, their cost of liquefaction is not, say, the $3 or $3.50 per MMBTU. It's actually about $1, because remember, they own the MLP. They also own the GP of the MLP, so all that cash flow flows back to them. Their net cost is usually only about $1. So the marketing book actually is in a pretty good advantage situation, even at current prices.
Good stuff. Cheniere is truly a fascinating company with a fascinating story. Now you have these two big guys going at it. You have a Carl Icahn versus the Jim Chanos. Thank you so much, Will. Such a pleasure. Will Fraunhofer, BTIG analyst.